Hey traders, today we're diving into something crucial. The major market averages are looking pretty extended from their key moving averages. We'll break down what this means by analyzing the daily charts across the large, mid, and small cap indices. Plus, stick around to the end. I've got a valuable pro tip that you won't want to miss. My name is Rick Petticelli, and with over 20 years of trading experience, I'm here to help you navigate the markets. Let's dive right in. First up is a chart of the S&P 500 ETF SPY. As you can see, had a nice bounce off the 20-day EMA in blue here, installed at the prior high, has already put in a few days of chop, which I would view as constructive action. And of the charts we're going to look at, this is probably one of the better looking charts here. It's not as extended from the shorter term averages with the 8 EMA just below here, this green line. So the S&P is in pretty good shape. Could use a little bit of chop as it's doing right now, but overall not too bad. Now on to the mid cap S&P 400, and here we have a more powerful thrust off the support of the 20, with 6% move here. As you can see, we're a bit more extended from the 8 and 20-day EMA. So ideally, we'd like to see more chop out of MDY or even a pullback to the 8-day EMA, which would allow the price action to digest gains. Overall, though, pretty strong action, especially if the price is able to hold above the last swing high, as it did here in November. There was a slight dip below the prior high and the 20, but then a quick recovery back above. That's what we'd like to see here. The price action can pull back to this, maybe the 606 area, 607, but hold and then push higher. So overall, strong price action in the mid cap 400, but may need some time to digest gains. And on to the Russell 2000 ETF IWM. Like MDY, pretty explosive move off the 20 EMA and is a bit extended from the 8 and the 20-day moving averages and could use some chop, which it's doing currently. Failed to push through the prior swing high, stalled out right there. So some chop here would be ideal as well, allowing the 8-day EMA to catch up. Now to the Dow Jones Industrial Average ETF, DIA. Also extended from the 8 and 20-day moving averages. Did set a new swing high. So some pullback here would be ideal. Digest gains, but overall strong action. And finally, on to QQQ, the NASDAQ 100 ETF, which is a big-time laggard during the current rally. Struggled to even push through the highs of July. The last rally didn't even come close really to the last swing high here. And the bounce off the 20 EMA didn't get very far before the price action had to pull back into the 20 again on Wednesday. So it's really one big chop in between the 516 to 495 area. Anything is possible within this range. And the chart would still be fine, nothing really going on. And you can see here, since it's lagged so much, it's probably the only index that's close within striking distance of the 50-day MA within a day or two if it were to roll over below the 20. Not saying that's going to happen, but the 50-day EMA is pretty close. And some of the struggle in QQQ has to do with the weakness in the semiconductor area, which led the market higher earlier this year. It's really struggled. It's nowhere near the prior high, the July high, and it's actually making lower highs and lower lows here and is below the 8, 20, and the 50-day moving average. And a lot of that is due to NVDA. If we go to chart NVDA, although it's showing quite a bit more relative strength than SMH, its recent breakout attempt failed, and now the price action has pulled back to the 50-day MA where it found support on Wednesday, which is a positive sign. So we'll have to see if the price action can chop around in this area and eventually push higher from here. So with the majority charts we've just shown you, a bit extended from the 8 and especially the 20-day EMA, some more sideways to lower price action can be expected. That would be constructive, actually. As we've mentioned several times, it would allow the price action to digest recent gains, as well as provide fresh new setups. The past few weeks, it's been tough to locate lower risk buy points. And when that happens, it's generally because stocks, for the most part, are extended and no longer near ideal buy points, which are the 8 and 20-day moving averages for us. So if anything, now's the time where we're looking to trail stops on winning positions and as well as limit the losses in positions that haven't followed through or have little to no profit buffer at all. And if the market does pull back in, the stocks that moved up the least are the ones that we'll look to cut first, while we'll try to hold on to ones that are shown the most strength over the past few weeks. So that's a wrap for this video. Thanks for sticking around. And as promised, here's the pro tip. When analyzing charts, we'll always draw these uptrend lines, and those are great. And that's what NVDA bounced off of today. But it's also a good idea to draw trend lines from prior highs, as they can show where there is potential for resistance. For example, if we're to go to a chart of Dow Jones, EIA, you could draw a line right here, and it's not really touching there, but if you were to come down here and touch a few of these real bodies, you have some resistance in this area. If we were to start from back down here, you'd have a pretty good idea of where you could expect to find some resistance. After a solid advance, go to a chart of MDY, and it's possible if we connect here, see we have some resistance right here. So, I mean, it's nothing groundbreaking here, but connecting the prior highs can give us a pretty good idea of where an index might have some trouble pushing through, and it may need to chop, especially when it's extended from the 8 and 20-day EMAs. Well, that's all for today's market analysis. If you found this helpful, make sure to hit that like button and subscribe for more trading insights. Drop a comment below with your thoughts on these extended market conditions. And always remember to trade what you see, not what you think. See you in the next video.